Trading stocks can be a lucrative but risky venture, and to maximize your success and minimize potential losses, it is crucial to follow certain fundamental guidelines. Having clear goals can help you stay focused on your investment strategy and avoid making impulsive decisions that may lead to significant losses. Finally, it is essential to use a disciplined approach to trading and avoid letting emotions cloud your judgment. Number 7. Can't afford to invest yet. Delay investing until you are financially capable of doing so is a smart move, though investing early can result in greater long-term growth for your investments. It's best to sort your daily finances before investing. You can follow these steps to ensure that you are ready to invest. Establish an emergency fund with readily accessible money to help you deal with unexpected situations without having to withdraw from your investments. Eliminate any outstanding debts and avoid using credit cards for investing, since interest and fees can accumulate quickly, surpassing any investment gains you may make. By sorting out your daily finances as soon as possible, you'll be able to determine what amount you can afford to invest. This will also allow you to contribute to your investments regularly, increasing your chances of achieving your investment objective. Number 6. Diversify. It is crucial to diversify your investments to minimize risk in an unpredictable environment. By distributing your funds across multiple firms, assets, and regions, you reduce your dependence on any one entity to deliver a return. Consequently, even if some of your investments underperform and suffer losses, your other investments can offset them. Some people opt to invest in a fund that delegates the responsibility of choosing which assets to invest. Number 5. Consider your risk appetite. When investing, it's important to consider your personal level of risk tolerance by asking yourself relevant questions. For example, how comfortable are you with the possibility of losing money? What is your current financial situation, including emergency funds and savings? And how long do you plan to invest? Ultimately, the level of risk you choose should be based on your individual circumstances and preferences. Number 4. Consider starting as soon as you can. It's advisable to start investing as soon as possible if your financial circumstances allow it. While it's understandable to delay if you're not yet ready, it's important to keep in mind that postponing your investment journey may cause you to miss out on potential growth. On the other hand, starting early can allow you to benefit from market movements and the power of compounding. Compounding refers to reinvesting profits or dividends back into your investment plan, which can generate further gains over time. By starting early and allowing your gains to compound, your investment could snowball and accumulate over the long term. Therefore, it's best to begin investing as soon as you can to take advantage of the magic of compounding. Number 3. Look out for investment fees. Despite what advertisements may suggest, investing is not free. Whether you invest independently or by a digital investment platform, fees will be charged, and they can reduce your overall returns. Therefore, it's crucial to minimize these costs as much as possible. One way to do this is by comparing fees from various providers or platforms. However, it's essential to not only focus on fees, but also evaluate the quality of their service offerings. Ultimately, the value and quality of service you receive should also be considered, as it's not just about the fees and charges involved. Number 2, make sure you're thinking long-term. It's important to keep a long-term perspective when it comes to investing. Investing is not a short-term activity, but rather a journey that should span several years. Long-term investment offers many benefits, including allowing your money more time to potentially grow, minimizing losses by riding out the bumps, and increasing your chances of making gains. According to several studies, investors who invested in the FTSE 100 for any 10-year period between 1986 and 2019 had an 89% chance of making a positive return. Therefore, focusing on long-term investment can be beneficial and help maximize your investment journey. Number 1. Panic. As an investor, experiencing a decrease in the value of your investments can be stressful. However, it's essential to resist the urge to panic and sell, as this would convert your losses into reality. Alternatively, holding on to your investments for an extended period could keep your losses hypothetical and potentially benefit you in the future. While no one can predict the future, historically, falling markets have recovered, and by persevering, you could benefit from better returns. Therefore, by maintaining your composure and not selling your investments, you may avoid regretting your decision in the future. Most of the guidelines mentioned earlier share a common focus on risk management and minimizing losses. However, the key is to limit losses to a level that enables you to continue trading and discover more profitable trades. Experienced traders are aware to cut their losses and have included this aspect into their trading strategy. They also understand when it's appropriate to take profits, such as adjusting their stop loss to secure some profit or selling at the current market price.